Frontier markets are essentially fast-growing emerging markets, but that they are not large enough to be included in widely followed global indices. So you can think of frontier markets as next-generation emerging markets that are driven by structural growth stories and reform processes, but they are usually overlooked by an average investor. These markets include the markets like Vietnam in Asia or the Philippines, but at the same time they include Saudi Arabia in the Middle East, Egypt, Georgia, Romania, and some of the Latin American markets. Well, there are three reasons really. The first one is growth. You have high structural growth in frontier markets, and from this perspective they look like emerging markets maybe 30 years ago. When you look at an average frontier market, you see 4 to 4.5% GDP growth. The range is pretty wide, 3 to 7%. Some markets are growing by 5 to 7% every year. Some are a little bit more mature, growing by 3 to 4%. But when you compare this 4 to 4.5% average growth to emerging markets, you see that emerging markets on average are growing by 3.5% a year, and developed markets are growing by 1 to 1.5%. And the second reason is a bit of a surprise to many, and that is frontier markets have lower volatility compared to both emerging and developed markets. And the third reason is mostly about valuations in frontier markets. These markets are going through a lot of distress, a lot of challenges, but they are also showing high growth. And that comes at a price for equity investors. When you look at overall pricing of frontier markets, we are talking about 7.5 times price to earnings ratio for our strategy, for instance. And these companies are really growing at 15% a year. So when compared to emerging markets, which trade at 11 times PE, or developed markets which trade at 18 times PE, you have a significant re-rating potential, but more importantly, even if this re-rating is not coming over 1 or 3 years, you have good downside protection in frontier markets with the potential to re-rate to come closer to at least emerging markets over the years. And when you invest in an actively managed strategy such as East Capital Global Frontier Market Strategy, you have lots of stock picking opportunities on top of the overall investment case. So we launched our Global Frontier Market Strategy 9 years ago. Since then we have been traveling extensively in the countries that we invest in. I've been based in Dubai for over the last 7 years, meeting with many companies, visiting many countries together with the team over the last 9 years, and even longer actually, because we have been investing in frontier markets for about 15 years now, starting with the Middle East, expanding into Asia, and of course with lots of investments in Eastern Europe throughout our history. But what we look for companies when investing in frontier markets is really, we like to invest in simple and easy to understand type of businesses that are driven by structural growth stories. And when we look at the companies that we like to invest in, we like to make sure that there are strong management teams in place. We like to make sure that these are highly profitable companies. And in terms of positioning and looking at the valuations, valuation is really important to us. We don't buy companies just because it's a good business or strong management team. We need to have a good degree of downside protection when we invest in stocks. So valuation is important, but it should be a level that you get a downside protection with a decent degree of valuation, but also you need to be able to capture the upside potential in these fast-growing companies. And when you look at our process, we very well integrate ESG in our processes. It starts from day one. We have hard exclusion, soft exclusion in certain sectors. We don't like companies with high carbon emissions, among other considerations, but that's really the simplest step on our ESG process. If you look at our track record, I think it's been pretty consistent. Out of these 9 years, we had 8 years of positive gross alpha, so far so good. This is coming as a result of our robust, consistent and repeatable investment process that we have been running since the launch of the strategy.